Record high inflation levels in India and overseas continue to dent investor confidence as disrupted supply chains due to Russia-Ukraine crisis build up price pressures on the economy. However, an analysis of historical data shows that high inflationary environments are not necessarily unfavorable for equity markets. For instance, between April 2013 and March 2014, the markets were resilient despite inflation levels of 8 to 11%. Of these 12 months, the Sensex and Nifty delivered positive returns in 8 months. Similarly, between April and December 2020, the benchmark indices gave nominal negative returns in only 2 months despite average inflation of 6.6% during the period. Overall, the retail inflation has risen 60 times on a month-on-month basis since April 2013, wherein positive monthly returns were 38 times and negative returns were 22 times. This, analysts say, is due to an environment where high demand coupled with high prices leads to rise in corporate profitability and nominal growth. Naveen Kulkarni, Chief Investment Officer at Axis Securities, believes that current inflationary pressures remain less of a worry for markets as companies are witnessing robust demand amid high prices.
So, inflation in a zone is probably a sweet spot. Inflation probably out of a particular zone or out of, let's say, when CPI were to reach double digit in case of Indian scenario, will be a very, very challenging one. Let's go back to scenarios of, let's say, 2012 to 2014. Markets didn't do much, but inflation used to be very high. It used to be 13-14%, right? That's when it was a challenge. But let's say markets in 2010-11, inflation was high, but markets did well. So it all depends on where we are in terms of cycle, where it is. See, in the current cycle, one is inflation is high, but also product prices are also very high. So in that scenario, what's going to happen is that earnings for most of the sectors is going to look very, very attractive. So my limited point here is that we are in a scenario where corporate profitability is looking very, very good. Demand is still robust. When this inflation will have a severe impact on demand is probably needs to be seen. If inflation does not come down in a more manageable zone, which is, let's say, 5%, 6% kind of a zone, which is okay from an Indian perspective, by next year, then we will have serious challenges. If inflation continues to rise from here, and it is going to be a serious challenge. If inflation is here and it slowly starts ebbing, then I think it will be very, very good for the markets.
With March CPI inflation leaping to 7% and rising above the RBI's upper tolerance band for the third straight month, brokerages expect inflation to remain higher ahead and see interest rate hike cycle to begin from June. Global brokerage HSBC, for instance, says that it raised the inflation forecast of FY23 to 6.1% as against RBI's 5.7% and its FY24 inflation forecast to 5.2%. The brokerage expects repo rate hikes to begin in the June meeting with likely 4 repo rate hikes of 25 basis points each till December 2022. The brokerage further sees 2 repo rate hikes of 25 basis points each in April and June meetings of 2023, which would finally take the repo rate from 4% now to 5.5% by mid-2023. That said, the near-term outlook for the market remains bleak as the Russia-Ukraine conflict stands in a deadlock with no prospects of peace in sight. Kulkarni of Axis Securities expects the market to remain range-bound in the short term as interest rates will begin rising given the inflation situation.
So overall, my core belief is that we are in a range-bound market for the next 3 to 4 months. Probably 16,000 on the lower side, 18,100, 18,200 on the upper side, and that's where we will remain. Post that, it remains to be seen how inflation will pan out, and thereafter we'll be able to take a call. So important factor is, of course, from a medium to long-term perspective, demand should sustain. How much impact of inflation will be there on demand scenario is very, very critical. And also the accommodative stance of RBI, how that will also continue. So there are multiple factors which are going to play out.
Given this, Kulkarni believes that commodity players will benefit from rising inflation.
So in an inflationary environment, typically the commodity sectors will benefit for sure. Interesting would be how banks will behave. Banks can probably benefit with a lag, demand for credit could rise from the banks, right? So that is a possibility. So short term, of course, there will be challenges with regards to increase in cost of funds and things like that. But over the medium to long term, I think there will be more demand from the banks, there will be more working capital. So credit growth could improve well, right? So in a nutshell, I would say that typically value stocks will do well in an inflationary scenario, and probably the high growth stocks will not do so well in a high growth, high PE stock will not do so well in a inflationary scenario.
The market action will be stock specific today as investors will continue to track the fourth quarter results. Tata Elxsi, Angel One, Reliance Industrial Infrastructure and ICICI Securities are among those slated to release their earnings today.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.